What we're in, as we keep saying, is no longer the sort of textbook model where interest rates are the all-important variable, where capital markets are financing new capital spending. What we're in is a world where capital markets are basically rolling over massive amounts of debt. We've got to roll over about $350 trillion of debt, which is the outstanding stock. If debt outruns liquidity, what you get are financial crises. And that's what we want to try and avoid.
Michael Howell, CEO of CrossBorder Capital and also author of the book Capital Wars, The Rise of Global Liquidity, and certainly a friend of this show and someone we always look forward to having on. It is great to welcome you back, Michael, and great to see you as always.
Well, Julia, great to be here. Lots to talk about.
There's so much to talk about, and we are recording this on Thursday, November 14th, and a lot has been happening since we last had you on. And, you know, Michael, we kind of always start the program with more of that big picture, that macro view. And I know the key area of focus for you is global liquidity. So I want to just give you a moment here and take all the time you need to kind of set the stage, set that table when it comes to that macro picture and, you know, liquidity and what it's signaling right now, where it's headed. So the floor is all yours, Michael.
Okay, let's kick off. I mean, the basic idea we have is that liquidity, and specifically global liquidity, because liquidity is fungible, is the most important variable for investors to understand. It's what's driving asset prices. It's ultimately what's driving the real economy. And it's something that we need to monitor and understand. In other words, money is shifting markets and moving asset prices. That's pretty critical to a lot of decisions. So that liquidity is a cyclical phenomenon. It goes up and it comes down. When it goes up, it's clearly a lot more beneficial for everybody. When it comes down, it produces challenges. What we've had is an upswing of liquidity that's really been in train since October of 2022. It got a significant boost around the time of the SVB crisis, so the Silicon Valley Bank default in the US in the spring of the following year, 2023. And what we've seen is liquidity conditions really moving up pretty significantly ever since. That is something which has clearly catapulted risk assets higher. It's been a major support to Wall Street. It's elevated gold prices. It pushed up Bitcoin. And really, it's been one of the factors as well, which has supported the US economy. So liquidity is an all-important variable. So knowing where we are now in the cycle, and more importantly, where it's going, are really critical factors. Now, what I could do is, before we get onto the challenges, maybe they're out there in 2025, let me just give you a picture, which hopefully you can see on the screen, of the global liquidity cycle, which is going back to 1970 or thereabouts. And you can see that cyclical movement. The black line in the chart is the actual data that we collect. And that is basically derived from monitoring something like 90 financial systems worldwide and actually extracting the amount of liquidity and creation that each country is undertaking. Clearly, the US is the most important, or the US and China are the most important. Europe clearly plays a role. Japan plays a role. But you get the idea, where it's a comprehensive survey of what's going on. You can see the cycle there. We've basically put on top of that, overlaid a sine wave. That sine wave fluctuates with a 5 to 6 year frequency. And broadly speaking, the liquidity cycle tends to follow, in very broad terms, that sine wave. The liquidity cycle bottomed on Q in October of 22. It's slated to peak in late 2025. We're about midway through that cycle now, and it's really been behaving so far reasonably well. What we're facing is a situation, we think, in the next 12 to 18 months, where there are beginning to be a lot of challenges on that liquidity pool. And I think the other thing one's got to say is that one of those challenges as well is the fact that investors have really front-run of all of this liquidity. So in other words, euphoria in markets, in many cases, is anticipating better liquidity conditions to come. That may or may not transpire, as we know, but clearly that's one of the factors one needs to take into account in any assessment. Maybe finally, what I'll say on this section is, what is liquidity? We measure it in terms of the flow of money, that's credit and savings through world financial markets. We're not looking here at a monetary aggregate, well-known monetary aggregate like M1 or M2. Those are very narrow measures. We're looking at financial money that is moving financial assets, moving through the financial systems. The best way to understand that is to think about the size or capacity of the financial sector balance sheet. In other words, the ability of banks and credit providers to actually refinance debt. And what we're in, as we keep saying, is no longer the sort of textbook model of a world economy that where interest rates are the all-important variable, where capital markets are financing new capital spending. What we're in is a world where capital markets are basically rolling over massive amounts of debt, and the world economy world financial markets rather, are much more debt refinancing mechanisms. In other words, huge debt refinancing mechanisms. We've got to roll over about $350 trillion of debt, which is the outstanding stock. And the capacity of the financial system, each year, we're required to roll over about 70 trillion. So you can see there's a huge amount of work to do by the financial market players, and therefore capacity of the system and liquidity is all important. If debt outruns liquidity, what you get are financial crises. And that's what we want to try and avoid.
That is what a great frame up. I'd love to just do a few follow-ons. I wrote that down. I thought that was interesting that we are a world of capital markets, of rolling over debt and refinancing versus, I guess, like financing new opportunities. Can we flesh that out a little bit more, put some more meat on the bones? Because that sounds, one, it piqued my interest, but also that sounds really problematic when you get into that situation. Walk us through that.
Yeah, well, actually, what I've done is to put another chart up on the screen, which is actually looking at the ratio between total debt, this is public debt, and private debt in the advanced economies relative to this pool of liquidity, pool of global liquidity. And what you can see is the data here, which in this case is annual data that goes back to 1980. And that ratio is displayed. And you can see that the ratio tends to be mean reverting and stable at around 250% average, which is the dotted line there. The bar on the right-hand side of the graph, the shaded bar, is a projection into 2025. And what you can see here is that ratio between debt and liquidity starts to go up. Now, the reason that this is important is that if you look at the way the graph is divided, when we're above that broken line, it says there refinancing tensions. And when you are below the line, it says ample liquidity. Now, actually, we've been in the luxurious position for the last few years where there's been a lot of liquidity in the system relative to debt refinancing needs. Now, I know that many people gauge debt or the debt problem relative to GDP, but in our view, that's not the right metric. The benchmark to use is debt to liquidity. And the reason for that is that debt needs to be rolled over, and you need liquidity to do the rolling over. And this is where you get problems in markets, because ultimately all financial crises, as far as we can see, come back to an inability to roll over debt. So you get refinancing tensions emerging in markets, basically because there's insufficient liquidity. When there is too much liquidity, we start to see asset bubbles or asset booms, if you like. And that's really what we've been in for the last few years. There's a lot of liquidity in the system. But as you can see, what's approaching is a period where there are greater tensions. And that's one of the factors that we highlight as a significant bogey for 2025, that markets had to jump. And the problem is coming because of a feature which is called the debt maturity wall that you may have heard of, which is that a lot of debt has to be rolled over in the next 2 years, really beginning about the middle of 2025, because an awful lot of debt was refinanced at the time of zero interest rates when corporations and, for that matter, governments decided they wanted to basically do a lot of debt raising, and they pushed out, or they basically did debt which matured really in the 2026-27 period. And that's what we're facing now. That debt maturity wall is starting to impose itself on markets. Now, as a sort of heads up, for example, if you take the US Treasury has to roll over around about 1/3 of the token debt of the US economy. That's 36 trillion in the next 12 months. So this is showing some of the strains that are likely to impinge on markets. On top of that, the private sector also has to refinance a lot of its borrowings. So you can see that markets face challenges. There may be a lot of liquidity in the system at the moment, but that liquidity will be grabbed by the markets as debt is required to be rolled.
This episode is sponsored by Public.com. You've probably heard a lot about interest rates in the news lately, but even as rates start to fall, there's still time to earn some of the highest yields we've seen in years. Public.com is a powerful platform for investors who are serious about earning fixed income. Here's a quick rundown of 3 yield accounts you can access on Public. First up, the high yield cash account on Public offers a 4.35 APY with 0 fees. That means every cent is yours. Then there's the Treasury account, allowing you to lock in a guaranteed yield with the U.S. Treasuries, widely considered one of the safest investments for your portfolio. And finally, the newest addition, the Bond account, lets you lock in an impressive yield of 6% or higher. If you're looking to earn some steady income even as rates change, head to public.com/Julia. Lock in your yield while rates are still up. So let me ask you this then, Michael, because when I look at this chart and I see where it spikes in those periods of like refinance intentions, you can kind of look at it, okay, like financial crisis, for example, is in there. So do you think, does this kind of mean that we could be headed toward recession? Is that a fair characterization, or is that part of the outlook?
Well, I think the thing to say is that if you look at the way that the world now works, it's the financial engine which is really driving the real economy rather than vice versa. We were always schooled in the idea that it was the real economy that came first, and then the financial markets kind of followed. So the financial markets really reflected the outturn in the real economies. I think it's much more the other way around now. The financial markets, which are becoming dominant, and they're really driving the business cycle. So if you get turmoil in the financial market, you're much more likely to see recession as an outturn, as a consequence of that. And you can see, some of the sort of deleterious effects that financial problems had, for example, in the global financial crisis, that a recession followed. After COVID, you got the same dynamic in a way. There were clearly problems with the refinancing at the time. But the authorities came in with massive monetary stimulus really to offset that and try and safeguard the world economy, which they did in many cases very successfully. In fact, the only economy that didn't really do that in size was China's, and you can see how much China has struggled to pull itself out of the COVID lockdowns, ever since. So that I think is the reality. It's the financial sector first, then the real economy follows. So will we have a recession? Well, the question is, will we have a financial crisis? But I'm not necessarily forecasting that. What I'm saying is that this is really giving a warning that we're moving into the territory where you're beginning to get refinancing tensions. And therefore, what you need is more liquidity to be injected in markets. Just go back and look at what happened in 1997 with the Asian crisis, 2008-9 with the GFC, 2019 with the US repo crisis. All these are examples of refinancing crises. And this is what we've got to be wary of looking forward. It's all about debt. That's the major issue we've got to face, and debt needs to be refinanced.
Okay, so that is the warning then. By the way, I'm reading Russell Napier's book right now on the Asian financial crisis, because to be honest, I don't know much about it, but I picked it up over the weekend and I started it. So I'm still working my way through it. But okay, so if this is the warning, we have a new administration coming into office in January. They're trying to make appointments now with the Trump administration. Curious, how do you kind of think about looking specifically at the U.S., the administration taking shape, how they might have to, deal with some of these challenges? We do have a debt problem here in the U.S. As well. So curious how you're thinking about it.
One of the great problems, and this is, I think, something which is likely to focus the mind of the new administration, is that a lot of debt in the last 2 or 3 years has been financed at the short end, rather than going to longer duration or longer maturity bonds, such as 10-year or 20-year or 30-year debt. A lot of it's been financed through bills, or it's been financed with 2 or 3-year notes. And that puts a lot of pressure on the markets because the rollover of debt is becoming more frequent. For example, out of that 36 trillion, you've got something like 6 to 7 trillion of debt, which is now bills. So a substantial proportion. I mean, it's well over 20% of total outstanding debt now is in bill format. And that means that the US government is clearly vulnerable to higher interest rates. And the fact that you've got a lot of debt at the shorter end is probably telling us that the Federal Reserve's ability to hike interest rates is actually quite limited, because what will then happen is if rates go up, the interest bill, which is already $1 trillion in the US, is going to start to move up significantly. Now, if you do the math of this and you start to say, well, okay, what we know already is the interest rates have been rising over recent years, and the average interest rate on outstanding US debt is currently just under 3%. But the average across the yield curve right now is about 4.3% or there or thereabouts. So if you assume that 1/3 of US debt has to be refinanced in the next 12 months, it will be refinanced at an average interest rate that is substantially above the interest rate where debt is maturing. And so therefore, what you've got to expect is the interest bill is still going to go up next year by a substantial amount, maybe by something like 15 to 20%. So that 1 trillion is not static, it's not coming down, it's going up. And this is a problem. The more that interest rates rise and the more the Federal Reserve hikes interest rates, the bigger the consequences in terms of ultimately the US taxpayer and the fiscal deficit. So these are issues which really need to be faced. So I think there should be a major priority on actually trying to get the deficit down. And we know that the incoming Trump administration has made some gestures towards doing this, through the appointment of Elon Musk to try and cut back fiscal outlays. Well, good luck with that. But I mean, certainly they're trying. So these are one of the issues. But I think if you go beyond that, what you also got to try and understand is the other risks to the bond markets. And, one would have to say that although you've got euphoria in stocks right now, the bond markets really haven't taken these events too well. That's not to say that if Camilla had been voted in, they would have had a different reaction. But I think the fact is that what you're seeing is bond yields are progressively rising here. And the problem is that inflation, certainly in our estimation, and this is not just a US call, this is a global call, it's actually becoming quite stubborn. It's not going down to the levels where central bankers have argued it should be, which is circa 2%. It's stuck at a level above that, maybe slightly above 3%, if that's core inflation. Now, that may not be a serious problem, but it clearly is, it's different from 2%. And what you would expect is the bond markets would begin to reflect that. Now, if you take the US economy, factor in that 3% inflation figure, let's say, and you assume the US economy is going to be growing, maybe growing a tad faster under Trump administration, maybe 2, perhaps 3% underlying, what you're then arguing is that nominal GDP, NGDP, is going to be somewhere in the 5 to 6% range, which, from what we know, is a pretty good benchmark for long-term US Treasury debt yields. So the 10-year bond, which is the benchmark for the US economy and for the world economy, is likely to be trading substantially above its current 4.25% level that it is now. And as you get a situation where bond yields progressively creep up, and as I say, this is not just a US phenomenon, this is a global phenomenon, equity investors are going to find themselves, excoriated, or to put it another way, gradually sandpapered to death. Not a particularly nice outcome, I know, but this has happened before. And when we saw this in the mid-1980s, when bond yields rose then progressively, equity markets were euphoric for many, many months, and there was lots of disconnect between the bond markets and the equity markets until there wasn't. And then equity markets started to realize the reality of higher bond yields. So this is something that we've got to pay attention to. And I know it's been unfashionable to look at bonds for much of the last couple of years, but bonds are out there. They're a very important instrument. They're a key benchmark for valuation. And if bond yields keep going up, equity investors at some stage are going to pay attention.
Okay, this is so fascinating to me. Just kind of the behavior that we've seen in the bond market of late. What do you think that's signaling? And I don't know if is that like the bond vigilantes coming back, or am I off there?
Yeah, well, bond vigilantes were actually a term that Eddie Arditi quoted or made up in the 1980s, and I think that they're back. Maybe it's a different form of vigilante than we had then, but certainly in terms of concept, that's right. And I think what bond markets are saying is that there's only so far that governments can go in terms of loose fiscal policy. They need to basically make sure that there is a fiscal discipline out there, and the bond markets will discipline them if they don't do it themselves. So I think this is an issue to face. And what we've had, as we've been arguing over the last 2 or 3 years, is despite all this talk that the Federal Reserve says, of course, we're tight, and there's a denial about whether fiscal policy is really that loose or not. What you've been seeing is, as we've sort of flippantly called it, not QE policies going on. So underneath, despite the sort of rhetoric of QT, the Federal Reserve has actually been pushing liquidity into markets. Now, whether that's been, of their own hand or also in collaboration with the Treasury, it doesn't matter. Liquidity has gone in through the Fed balance sheet. And the other thing is you've had not yield curve control. So it's mean unconventional yield curve control. But our estimates would suggest that actually yields in the US, bond yields, in other words, at the 10-year tenor, are probably about 100 basis points below where they should be. Now, that's been by dint of a number of things, but one of the things that's been very important has been the skew in Treasury issuance towards bills and towards short-dated notes. And that's really starved the long-term institutions, the pension funds and the life insurance funds, out of duration instruments. So they basically bid the price of longer-term bonds upwards, which has suppressed their yields. Now, this clearly matters because it's a distortion. It's a distortion that can't go on for very long, so it's a short-term fix. Janet, we know, is leaving the Treasury, so it'll be someone else's problem. And that problem really needs to be faced. Now, if you look at what does that mean in terms of traditional indicators, 2 warning signs are, first of all, take the yield curve, which has been everyone's sort of perfect measure for a long time, of whether the American economy is going into recession or not. And that yield curve has been inverted. In other words, the long end has been yielding below the short end of the market. So you've had a negatively sloped curve, which normally, or has in many cases, foreshadowed recession. But it hasn't done this time. Why? Because the long end is distorted. If you added this 100 basis points back to the long end because of this issuance distortion, you'd actually find that the yield curve is upward sloping, admittedly not by much. In other words, it's been indicating a non-recessionary economy, but actually an economy that's still growing, which is what we've had. And then if you look at break-even inflation rates, whereas if you look at the TIPS market, you've been looking very recently at break-even inflation rates closer to 2%. In reality, if you redo the math and include this 100 basis points extra, US break-even inflation is actually now about 3.5%. So it's substantially above, where the market or where the Fed is broadly indicating it is. So what we've got here is, if you like, already, as the new administration kicks off, some parameters that are really abnormal or not in the market's normal sense. So this is something that needs to be taken into account. There's more inflation out there. There may be more growth as well. The US economy is not going to go into a recession, but those 2 facts alone are going to start to underpin our rising yields. And that's really what we've got. And therefore, our conclusion in all this is that basically, number one, you want to be a little bit cautious now. I mean, I'm not saying, let's hit the sell button and fire the markets. That's not what we're saying. But you've got to be a little bit prudent. I mean, after all, markets have gone up for 2 years now, just over 2 years. And normally by this stage, you'd have seen about 3/4 of a normal bull market's gains. Not to say there's not more to come. I'm not saying that, but I'm saying that the easy money has been made. And if you look at the sequence of how equity markets or asset markets have unfolded, they've been pretty much on cue. There's very little to disagree with a normal script here. You've seen the normal pattern from technology moving through the financials, etc. In terms of performance. Small cap is catching up, which you'd not expect. So the internals of the market have been very consistent. The fact is, though, that what you need looking forward is to do two things. One is to think about rotation in asset market. And the second thing is to have more monetary inflation hedges, of which, I would include gold. Gold can be volatile, as we've seen in the last few days, but generally the trend is upwards. And also cryptocurrencies, things like Bitcoin. Bitcoin clearly has been volatile the other way, but this is something that an instrument that we still think you need in portfolios, and you need to hold for longer term. Not really necessarily to trade it. That's not really our game. But, it's a long-term monetary inflation hedge. And gold, to give you one example, gold is a very good hedge against the, inappropriate policies of any government. U.S. federal debt since year 2000 has gone up an astonishing 8-fold. Okay. The price of gold since year 2000 has gone up 8.25 times. So they pretty much match. If you think U.S. federal debt is going to keep going up, so Elon doesn't succeed, in other words, then you've got to say, well, okay, I need gold with my portfolio.
Mm-hmm. I suppose like gold in that case, it's more about wealth preservation. Is that a fair way to characterize it?
Well, it's a wealth preservation in nominal terms, yeah. I think the other way, which is, often a difficult way to think about this, but it's not really the gold price that's going up here. It's actually everything else which is devaluing against gold. Gold is a little bit like, the pole star in the heavens that navigators would watch. It's the fixed point. When gold is going up, it's really, the dollar going down against it or other assets going down against it. So gold is, as you rightly say, in that sense, is a wealth preserver.
Yeah. Well, I know it's definitely a topic a lot of folks who watch this channel care about. And I heard you say also cryptocurrencies as a monetary inflation hedge. Do you own Bitcoin?
I do personally, yeah.
Okay, got it. And talk to me about how, maybe for folks who are watching, listening, thinking about cryptocurrencies as monetary inflation hedges alongside gold.
Yeah, let's be clear here that in terms of the track record, gold has got a much, much longer track record. We're talking about thousands of years where gold has provided a backstop against monetary inflation. It's a very, very good monetary inflation hedge. I need to stress the fact that gold is not necessarily a high street inflation hedge, because monetary inflation and high street inflation are very different things. What goes into high street prices is partly monetary factors, but also a lot of other things as well. So you could factor into that technology gains, you could factor into that cheap Chinese goods, you could factor into that taxes. So there's a whole host of things which go into high street prices, which are not monetary factors. But monetary factors are important. Now, as it happens, in the last 20 years, what we've seen is a huge monetary inflation, which is why gold's gone up. But there have been other factors that have actually kept prices low. One of them being China, another one being technology. Those are factors which have suppressed high street inflation. So if you think that those are unraveling, then you're going to see high street inflation moving more with monetary inflation. Gold is a monetary inflation hedge, and that's what it's demonstrated over thousands of years. Cryptocurrencies like Bitcoin, we have a much, much shorter track record, but they have performed as monetary inflation hedges in that short window, 5-year window, pretty much as well, and at times better than gold. So what you find is that Bitcoin is actually extremely sensitive to liquidity conditions. And therefore, if you expect liquidity to expand, therefore you've got to own Bitcoin. If you expect the liquidity is going to go down, then I would be avoiding it temporarily at least. What I've also done on the screen is to show the asset allocation that we look at. And I might need to go back one slide or two to show the cycles and how these cycles evolve. Now, these are the cycles that refer to liquidity, which I showed earlier. And this is basically showing how the liquidity cycle is now leading the real economy cycle. the liquidity cycle is in orange, the real economy cycle is in red. The red blobs on the chart are when the yield curve, in other words, the fixed income markets, the yield curve inflects. So all these are really points. This is a roadmap, if you like, to try and show where we are. Now, we believe at the moment we're in the calm phase for liquidity. And that we can demonstrate in a moment. But we also show here that there are 4 investment regimes that we can identify called turbulence, rebound, calm, and speculation. Now, the liquidity cycle tends to lead the real economy by around a year or so. What you have here is the distribution of markets worldwide, showing which zones they're in. The red is looking at turbulence regimes. So in other words, there's very few markets out of the 90 we monitor, and these are very small markets, I'd also say, which are in that turbulence zone where liquidity is not that great. The orange band is markets that are in speculation. The green phases, carbon's rebound, are the more benign areas. So what you're looking at here is about 80% of the world currently is in this benign area. Now, if you're a contrarian, then maybe this is bad news. You want to start saying, well, okay, there's an urgency or a need for me to start to be a little bit more prudent. As a heads up, that tends to be, a pretty good call about a year hence. So I wouldn't disagree with people that are saying, well, okay, we need to move the supertanker gradually. It doesn't necessarily say that we're about to see a financial crisis on this basis. In other words, what we're saying is, can it get better than this? And the answer is, well, it's kind of unlikely, but it may stay elevated for some time. And if you go back to 2022, you'll see the red band was at its highest, at its peak, around about the summer of 2022. And that was a period basically where you saw, which were in the midst of, financial meltdown. And then things started to get better progressively. If you look at the asset allocation recommendations, what you can see there is a series of traffic lights. Those traffic lights on the left-hand side are looking at asset classes. The traffic lights on the right-hand side are looking at industry groups within the stock market. And what it's basically arguing is that the first of those regimes, when the liquidity cycle just bottoms and begins to pick up, is the rebound area. So that would have said that if you're in rebound, you want equities and you want credit markets. You don't want commodities and you don't want bond duration. As you move towards calm, what you want to be doing there is starting to move more towards equities, shifting out of credits, putting more into commodities, still avoiding bonds. And once we get further into the cycle, you can see that bonds then become a much better investment. So you've got to pay attention to the cycle. If you look at the right-hand side, what that's saying is that in terms of the upswing of the liquidity cycle, you want cyclical exposure. You don't want defensive stocks. You want technology, which tends to be a leader. You ultimately want to be moving next into financials and then starting to move towards energy and commodities. And those are really this is the rotation that's going on the market. So technology clearly has been very good. Financials have been good over the last few months. So that's sort of reinforcing that factor. Maybe energy or commodities are the next things to look at. But, we've got to be cognizant that there is an elephant in the room when it comes to commodities, and that's called China. And, China is one of the factors. And I'm going to go sort of forward in my presentation to show the risks here. This is what we envision for 2025. And what I've shown in this slide is you've got global liquidity supply, which, as we argue, is likely going up. I mean, after all, central banks want to ease, been saying that even regardless of the inflation backdrop, they seem to want to cut interest rates. Jay Powell's claiming that inflation is beaten, etc. I'm not convinced by that. But anyway, that's the view. They want to cut rates. They want to get liquidity up into the system. Banks are now lending. Look at the last senior loan officers survey that came out a few days ago. Again, very upbeat. So what you're looking at is increasing liquidity supply. But then on the right-hand side, you've got increasing challenges for that. I mean, one is Chinese demand, which I'll come on to, higher inflation needs, debt refinancing needs. And I've tackled the debt refinancing. The higher inflation is probably, obvious in the sense that if you get higher inflation, the real economy will need more liquidity to pay for the higher prices. So that's clearly sapping financial markets of excess liquidity. The Chinese demand one is really a sort of puzzle in a way. And that is because China is a dollarized economy, like it or not. A lot of Chinese trade is denominated in US dollars. I mean, I know they're trying to get off the dollar hook, but unsuccessfully so far. And Chinese banks have very, very big gross positions in the dollar. So, all the talk about the dollar is going to fade, as the major currency worldwide, completely fanciful. I mean, that's just an impossible ask. The dollar will be around for a long time and it'll be, in demand. And if you start to think about what's going on in China, let me illustrate, some of these features. Now, the Chinese economy is clearly in a bad place right now. And part of the reason is that they've been unwilling or unable to stimulate the economy following the COVID lockdowns. A lot of the problem has come through the yuan exchange rate. And the Chinese yuan has been challenged by the very strong US dollar. China has had a policy, albeit a sort of maybe secretive policy. And that policy is basically being trying to stabilize the yuan against the US dollar. And whenever the dollar is strong, China suffers and has to tighten monetary policy. Now, what you're looking at in this chart is the liquidity injections of the Chinese central bank, the People's Bank, into the Chinese markets. Question is there a trend going on there? Very difficult to see one. And in actual fact, one would have to admit, if you look closely at that chart, for the last few weeks, they've been actually taking liquidity out of markets. So this is not a China that at the moment wants or can ease policy. Given the fact that China is the elephant in the room when it comes to the industrial economy worldwide, this is not great news. And it's suggesting that we may be seeing a little bit of a setback, maybe in commodity markets short term. Now, looking through this, I fully expect the Chinese to ease. They have to, okay? Their economy is in bad shape. This may be a tactical move to try and give them some sort of respite over the yuan currency, but ultimately they've got to ease. They've got to get the yuan weaker against the dollar. They need to devalue their real exchange rate, and ultimately they need to revive the economy and get out of this big debt problem they've got. They need to print money. The packages that have recently been announced by the Chinese government, the Chinese authorities, basically allow them to do that, although they're very vague at the moment. There's nothing really explicit in writing. But the evidence is there that they're prepared to do this, and if you might, recapitalize the economy through the banking system. Now, what does it mean near term for investors? And this is, again, one of the things one's got to watch. Now, never say never in financial markets, and this is why I'm bringing up the point about commodities. What we're looking at here is PBOC, People's Bank of China, liquidity injections in markets, which is the orange line. Okay, it's erratic, but you can see this is a rolling 90-day average of what they've been doing in their money markets. China's People's Bank has huge control over the state-owned banks, and the state-owned banks, if you like, the sort of umbilical cord that connects in with China's state-owned industry. It's still very much a centrally planned system, and everything comes back to the People's Bank and the banking system and their control. And they have tremendous control. What you're seeing here is that fall off in liquidity, the orange line, is foreshadowing weakness in the world economy. Now, the black line that we show there is our own in-house nowcast of world economic activity on a daily basis. And it seems to line up pretty well with about a 3-month lead time of Chinese liquidity. So what this is saying is what you may be looking forward to, or not looking forward to as the case may be, but about to happen in other words, is a situation where commodity markets start to fall away, and there are concerns about the health of the real economy in the near term. That is something which is an air pocket that may come back to bite us. If that situation worsens, and this is why I'm citing Chinese demand, it may be that you get distressed borrowers in China and they're forced out into the Eurodollar markets and start to bid the dollar up even more. and start to cause more and more tensions in markets. So the bottom line here is, I don't know, but you've got to monitor what's going on in China because it's clearly important as equally as you're monitoring what Federal Reserve is doing. So bottom line here, again, is that 2025 is emerging as a year that looks a lot more uncertain than 2024 did.
Yeah, definitely challenges to pay attention to as it relates to global liquidity. And I just want to go back to one point that you made too, of just even the markets, the equity markets specifically, they're quite euphoric right now. They might be missing the signals coming from the bond market. What is more of your outlook for equity markets, and what is really, I guess what I'm trying to ask here is what is the disconnect? Why are they so euphoric?
Well, I think that I would say they're understandably euphoric because the Trump administration is promising to basically cut taxes. The red sweep through Congress is basically, telling us that the chances of a corporate tax cut are very high. And the fact is that they're going to cut back on a lot of regulation. What's not to like from an equity market standpoint from that reason? Earnings going to be up. What the equity market may be missing because it's being blindsided by this good news is the very fact that bond yields, in other words, what impinges on valuations, are moving up as well because the bond markets don't like what they see in terms of the inflation message, or more particularly the debt issuance message, which is likely there's got to be more debt issuance. So partially what Elon Musk can do, the reality is that outlays are probably going to be higher. They're rising anyway because of the increasing costs of Medicare and Social Security from an aging population. These are facts that are very difficult for any administration, whatever the strike, to tackle.
Yeah. I have to say, Michael, we love having you on the show. We love when you bring in your charts as well and help all of us learn and get better. And I want to give you the final few minutes here. Obviously, let folks know where they can, find your work. I know you have an amazing Substack as well, which has the same name as your book, Capital Wars. But yeah, let folks know where they can find you. Anything that we didn't mention in this episode that you'd like to leave this audience to think about, the floor is all yours.
Okay, well, that's very kind. The best way to contact us is, as you say, Capital Wars, which is Substack. You can look at the Twitter or X handle, which is at CrossBorder Cap. And we've got a website for institutional clients, which is www.crossbordercapital.com. I think the summary of this is to say that, number one, 2025 is more uncertain. I think that, as I said right at the beginning, equity investors are kind of front run the increase in liquidity that we've been seeing. I think there are uncertainties out there, which I would say inflation, the debt maturity wall, and China are the three ones that we'd really cite. And any one of those three could derail the markets, in the short term. Is this a time to sell everything? No, it isn't. I still think the climate is still pretty decent for risk assets generally. But as we know, risk assets never move up in a straight line. They move in cycles. So I think there could be an air pocket near term. That's what we're concerned about. But broadly speaking, in terms of portfolio allocation, the 60-40 portfolio that everyone has known and loved, which is 60 equities, 40 debt, is dead. You've got to start thinking about reallocating that 40%. And what I would say, start to think about dedicated monetary inflation hedges. Think about gold, think about crypto, or more specifically, Bitcoin. Think about Treasury inflation protected securities. If you can get over 2% from a TIPS bond, courtesy of the US government, with an uncertain inflation environment, I'd take it because that looks a steal in terms of long-term real returns. And I would then think about having, as I say, a pared down exposure to generally government debt, because I think that's going to be one of the losers in the medium term.
Love it. Michael Howell, CEO of CrossBorder Capital. Thank you so much for being so generous with your time, your ideas, all of your knowledge and wisdom. And we look forward to having you on. We'll try to get you back on in the new year as the new administration takes shape, because we'd love to continue this conversation with you. So thank you again, Michael, for being so generous with your time.
Great, Julia. Thanks. Much enjoyed it. Thank you.